Hello, everyone, welcome. If you only trade stocks, why bother learning commodities? Simple. When crude rises, gasoline at the pump gets more expensive. When copper slides, it often flags a softer economy ahead. Look at the WTI crude chart on screen. Moves here ripple into freight costs, airline margins, and the price you pay filling up the car, and they can nudge the Fed's inflation narrative that drives this and pay 500 NS. Today we cover 4 commodity futures: crude oil, gold, copper, and natural gas. Each carries a different signal. We're not memorizing why this stuff is expensive. We're learning how to read the chart and connect it to the real economy, your household bills, and your portfolio. Let's get started. The WTI daily chart on screen is the U.S. inland benchmark, the one that most closely tracks what U.S. drivers feel at the pump. Crude has 2 big faces: WTI, West Texas Intermediate, priced around Cushing, Oklahoma, and Brent, North Sea/Seaborne World Benchmark. 포 이그젬플, 연 WTI 시츠 니어 $75, 브렌트 마이트 트레이드 어라운드 $78, 러플리 $8 3프리미엄. U.S. gasoline and diesel tend to lean on WTI. Global freight, European and Asian refiners, and most international oil news lean on Brent. Shipping costs and geopolitics create that spread. Think of it like retail. WTI is the local hub rack price. Brent is the world-delivered price once oil is on the water. Same commodity family, different price that matters depending on where you live and what you trade. So, watch the WTI chart on screen for U.S. pump and inflation effects, and keep a separate eye on Brent when global supply shocks hit. Both matter. They answer different questions. Gold pays no dividend and no interest. So, why do people swap cash for gold? The answer is real rates, the Fed's policy rate minus inflation. 세일 HR 3% and inflation is 5%, real rates are minus 2%. Bank interest is losing purchasing power. Gold starts looking better. 플리비트, 레이츠 5%, 인플레이션 2% 그러면 리얼 레이츠 플러스 3%. Parking cash or treasuries looks more attractive. Soft patches on this gold chart often line up with positive real rates. Caveat: mining strikes or geopolitics, war, financial panic can send gold flying regardless of rates. Read the chart and the headlines together. Bottom line: gold's long trend tends to follow real rates, but short spikes need supply, policy, and crisis signals on the side. Copper is nicknamed Dr. Copper, the metal with a PhD in economics. Investors take its temperature the way a doctor takes yours.
Why?
Construction wiring, EVs, data centers, solar panels. Almost every industrial build needs copper. When growth cools, building slows, factories cut output, and copper demand falls fast.
소프트 코퍼 오픈 슈저 비포 소프트 S&P 500 어닝즈 내러티브즈.
Fun twist. Copper and gold often move opposite ways. When gold rises, fear mode. Copper usually weakens. Watch that relationship live on the chart. Trap. A Chile mine strike or Peru political shock can lift copper on supply alone. Never treat. Copper up equals boom guaranteed. Read the trend on the chart, then check the news for supply disruptions. Only then can you say with confidence, this looks like a growth signal. Natural gas is nothing like the other commodities. Seasonality is extreme. Winter heating demand hits hard. And unlike crude, it's mostly a regional market. Look at U.S. Henry Hub, the main U.S. pricing point. Summers can sit near a too. A polar vortex winter spike can shove prices toward a 7. Spot that seasonal wave on the chart. For U.S. households, Henry Hub feeds into heating bills and power costs. Europe and Asia often pay a much higher LNG import price. When U.S. hub gas is around $4, overseas cargoes can clear well above $10. Aggressive U.S. LNG exports can also firm domestic prices.
소더 체인 이즈 리얼. 가스 스파이크 그러면 하이어 유틸리티 빌즈 그러면 스티키어 인플레이션. 더 세임 인플레이션 스토리 더 패드. 더 S&P 500 앤드 나스닥 와치.
Worth tracking even if you never trade the contract. Longer term, renewables may trim demand. Short term, winter weather and supply headlines still dominate. Pair the news with the chart. In futures, the spottish front month and farther out contracts are different prices. Miss that gap and you'll never understand why an oily tip can lag the crude you see on TV. On this WTI weekly chart, picture the curve. Front month $75, next month $76, 3 months out $77. That upward slope is Contango. Farther dates cost more.
Why?
Storage, interest, and logistics. Buying oil today and parking it in a tank costs money. Distant contracts price that cost in. Here's the pain. To stay long via futures, you roll each month into the next contract, and in Contango, you keep buying the more expensive one. Even if crude is flat, rolling losses can make oily TS underperform the spot story. Sometimes the front month is richest backwardation. That usually means tight supply or urgent demand. Rolling can then help you. Check the curve slope often. Takeaway. Once you can spot Contango and backwardation on the curve, the question, why did my futures-linked product lose money when oil looked fine, starts to make sense. Today's 4 takeaways. Crude equals energy supply and demand. Gold equals real rates and fear. Copper equals growth signal. Natural gas equals seasonality and geopolitics. Alone they confuse. Together they sketch the economy. Gold and copper often run opposite. Oil and gas share related cycles. Confirm those patterns on the charts yourself. You've heard supercycle, historically a multi-year commodity bull stretch. Even those end when policy, technology, geopolitics, or demand shifts. The key is refusing the story. We're in a supercycle, so it only goes up. Read the trend on the chart, check the news, and catch when the signal flips. That's how you stay in the game. Stop sign important disclaimer *. This lesson is for education only and is not investment advice. Futures and leveraged products can wipe out capital quickly. Every investment decision and every outcome is yours alone. Thanks for watching.